Hey everybody, welcome to this webinar on a Sunday afternoon. I'm Shane Smoleny from Wolftrader Futures, and today we have a very special webinar for you. We're going to be talking about high probability plays, and this is part one in a multiple series that we're going to be doing on high probability trades. I just want to make sure that we can have the audio coming through okay, so just let me know if you guys can hear everything okay, and we will get started shortly here on this webinar. For those of you who are new to the channel, we do these webinars once a week. We try to do different topics each week, and I try to cover a wide variety of topics, symbols, and this week is going to be the first in a multiple uh, series of multiple parts on high probability plays in the market. So some people like this concept of high probability plays, so that's what we're going to do. And there's different ways to look at this. So today we're going to start with the polar R squared, which is a indicator that I have here. That's a customized indicator. And we're going to be talking about regression analysis and how to look at that. So if you like the video, like the channel, go ahead and like and subscribe. That would be great. It would help us out with the channel. And also keep in mind that next Sunday or Saturday or Sunday, we're not going to have a webinar. So next week is off. We will be back the following week. The following week is going to be Christmas. So on Saturday, that's going to be Christmas. So we'll do a Sunday webinar on the 26th. So I appreciate your patience here with all of the holiday schedules going on and all the shuffling around. So I know things get a little weird here in the holidays, but we'll get back to our Saturday schedule after the new year. So if you guys ever need to contact me, you can reach me at shane@wolftraderfutures.com or www.wolftraderfutures.com or fedjuice.com. So these are the different ways to reach me. On the website, you can actually chat me on the Wix notifications, fedjuice.com too. We own this domain. We actually have a US trademark on the FedJuice, so that's why we own the domain also. So this FedJuice is really a powerful tool to look at multiple markets. YouTube, you guys are on Wolftrader Futures right now, so this is the main channel here. Twitter at Wolftrader FUTU1. You can check us out there. That's our free Twitter. We also have a closed Twitter for Platinum subscribers, but that is if you're a Platinum member, where we stream live information all day on the markets. So just to give you a little bit of a background here, what I'll do is I'll get out of the way so you can see this. So we're updating a few things here. So we have multiple services here. We have many different newsletters here. We have S&P, metals, energy, currencies, cryptocurrencies. Grains and Financials newsletter is coming soon. We already post this for gold subscribers and platinum subscribers. We post this every day with corn, the 10-year bond, and also the euro dollar. And we have double lunar cycles for everything here, all of these. And we also have Fed Juice for S&P. We have Fed Juice for gold, copper, and silver. Fed Juice for natural gas, oil. Fed Juice for US dollar, Canadian dollar, euro, British pound, Australian dollar, and Japanese yen. This is a big one. The currency newsletter is a very nice size newsletter. If you like the currencies and you want to see these different cycles, check this one out. Cryptocurrencies, we have Bitcoin, Ethereum, Ripple, Litecoin, and Cardano. We just added Cardano, so it's kind of new to the mix here, but we do have it. Grains and Financials, like I said. And then the Uranian newsletter, this is pure astrology. If you guys are interested in learning about the German Uranian method of astrology, that's what this newsletter is about. So we talk about different topics as they relate to midpoints and as they relate to the 90-degree dial or the fourth harmonic. So that's what this is. So I see some people in the chat here. So, I'd like to thank everybody for coming, and especially our two moderators, Ron and Pat. Thank you for showing up today, helping us out. We really appreciate that. So that helps us out here when we try to sift through all this material here. I appreciate that. So just a special shout out to everybody there. Gary, Allen, what's up, Allen? K. John, thanks for coming. So keep the questions coming too. If you guys have questions, I'll try to answer those questions. So stock and ETF service, we have this. Now the stock ETF service, guys, we just added a big runs to this. I added a big runs to the SPY, and so that's for the S&P. We have the big runs on the SPY, and then on the stock ETF, I added the fast Fed big runs for Apple. So there's a couple of swing trades coming in here on these two services too. we're always expanding services. So that's what that's about. So over here on the platinum, let's talk about this. So the platinum service over here is a live Twitter feed that's closed out to the public. It's a private Twitter feed, and it's a real good place to get information. I mean, we're streaming all day. We stream charts all day. You know, as soon as I get the charts, they stream there first, and then they go to the closing bells. But it's a good place to get just live updates throughout the day. We have the Fed use trading service option spreads, which are typically credit spreads. The fast Fed big runs, which has really been taking off here in the last couple of months. The easy timer, which is taking off on gold last month, really took off. Just so you know, the fast Fed big runs is a spread, it's not a spread, it's a swing trading system that trades for multiple days. It could trade up to a week at a time. Whereas the easy timer is very small trades that last for a matter of minutes or hours at the most. So these are just two different types of trades. This is more of a swing trade. This is more of a day trade. Uh, Code breakers. This is new. We're going to talk about this. This is a high probability play. This is coming. Code breakers is going to be analyzing the market price patterns of the past few days to come up with the code, to break the code, to figure out what the next day is going to be. So these are going to be 1 day plays, high probability plays, and this is going to be in about week 4 of this series. We're starting part 1 today, but the code breakers is for those of you who are platinum members. I did a little bit of a video about this on a section I call Nerds Corner, which is where I just talk about technicals. I get there and I just talk about analytics, and we kind of brainstorm and go through topics. So if you're a platinum member, you already know about the code breakers, what's going on with that. But I have been working on it over the weekend, and it's evolving rapidly. And I plan to have this for multiple markets beyond what we have here. I plan to expand this out into all of the softs, coffee, orange juice, lumber, cattle. I mean, all of these other markets, I'm going to expand the code breakers. So we're going to have the code breakers out for multiple markets, and you will have the codes for the markets. And what it does is it analyzes price history to predict the next day. So that's a big deal that's coming. And then, of course, as you are a platinum member, you get grandfathered in. So if you're a platinum member, you automatically get the code breakers. Code breakers is going to be a separate service. So, but if you're platinum, you guys already get that automatically. So that's what's going on. So the code breakers follows along the theme of the high probability plays. So let's talk about the disclaimer here. So trading commodities involves risk. So this is something that is, especially when you're dealing with futures, past performance is not necessarily indicative of future results. This is designed to be an educational service to go with the book that I wrote with Larry Pesavento, A Trader's Guide to Financial Astrology. So we're expanding out on these concepts all the time. So this is not me controlling your account or giving you direct advice. This is a newsletter, so everybody gets the same information at the same time. So I just want to make that distinction because sometimes people ask me like specifically about a certain position or what should they do. I can't really comment on that. That's your own account, your own thing to do. I do give the same information to everybody though, so just so you know. I do have a firm where I am a registered CTA, CPO, Trading Ridge, but that has nothing to do with this. This is a separate company. Wolftrader Futures is a separate company from Trading Ridge Analytics. And then the data used in this, everybody gets it at the same time. I don't give some people I don't send someone information first and then another person different information, or I don't give specific advice to one person. It's just everybody gets the same thing at the same time. I would warn you about using fragments. Fragments is a real dangerous thing. If you see something 1 week, uh, you might think it will translate into the next week. And because we're dealing with the Fed, we have a Fed meeting this week. Things can change rapidly. You can think one thing's going one way, and then all of a sudden it changes in the middle of the week. So just be careful about that. There's gaps here. We're in a market that's just literally bombarded with information overload with the Fed, with the high-speed trading. The reactions are getting more and more intense. The short covering rallies are getting more and more intense. So it's important to check back daily to see what my calls are. I have been doing some audio updates in the week too for you guys. So I put them on between the videos that we do. I put some audio updates there where I can kind of talk to you and tell you what I think's going on, because there was a lot of strange stuff happening even last week. These profit graph histories that you see are actual real signals. They're timestamped. We can document them. We can go back either in newsletters or on Twitter. That's the good thing about Twitter, is that everything that's posted is timestamped and you can't erase it. So it's there forever. And so, yeah, so it's all there. So it's not like I'm just posting random charts or back tests or something. This is published data that we're posting to you. I never sell your information. I never share your information. I've been approached many times to do that by, come speak at our webinar or come speak at our conference, but give us all your subscribers. I'm not going to do that. So it's just something that I feel strongly about, that this is private stuff, and I'm not Facebook or Meta or any of that stuff. I don't share anything. So yeah, if you sign up, if you get an email, it's because you signed up. It's not because somebody gave me your name and I put it on a list. That's just not how it works. If you get an email and you don't want the email, just unsubscribe. Okay, no problem there whatsoever. Uh, and my terms of service really is that you understand the risk here. Guys, you can make a lot of money with futures, but you can lose a lot of money with futures. So there's huge risk here. And sometimes things look like they're working and they stop working. So just want to point that out. All right, so news and events here. So the portfolio manager is continuing to go strong. I'm going to show you, I put a page on the actual website, which I'm going to go into in a minute. I'm going to show you that, how you can find that. Right now I have it open to the general public. I'll probably make it to site subscribers, which could be free subscribers too, but right now it's open to the general public. So I got a question here from Gary. I'll get to this. Shane, when and how do you expect to announce the code breakers selections? Okay. I know there's a lot of excitement about the code breakers. I'm excited too. The code breakers will I'll give you the code sequences of the days before what has to happen, like a combination of a lock. And then in the day, I'll post like for example, like you see this RSI chart here, like where I put the RSIs up every day for the platinum subscribers. I'll have a chart like this up for each symbol, and it'll have like if it's on pace for a long or a short. And so there'll be a column like this. It'll be like, so you'll see all of the symbols, and then it'll say, code breaker long. It'll say on pace for long, short, whatever. And they don't happen that often. You might only get a couple trades per symbol, or per side, per symbol per month. So you might only get one or two long trades for the S&P per month. You might only get one or two short trades for the S&P. So they're not going to show up that often. So that's why I'm going to do a lot of symbols. And then so you'll get this chart. So it'll be up, and then you'll see, the code breaker for that day. But it's going to be very, very high probability plays. And it's going to take me a few weeks to get through this. I'm working on the algorithms to optimize it, but it looks really good. Okay, so getting back to what we were talking about here. So the portfolios are doing really well. Look, we've been talking about this for like a month now, right? So they've continued to expand their profits in the last month, even since I introduced it. They're just continuing to expand out. The double lunar cycles are continuing. Even the S&P just closed out about 120-point gain on the double lunar cycle on Friday. So yeah, that's just going. It's going, and it's going fast. But that's not high. Those are not high probability plays, and I'm going to explain the difference in those, because today's webinar is about identifying plays that are high probability, like 70 or 80% chance that the play works. And there's advantages and disadvantages to that. So I'm going to talk about, a lot of it depends upon your personality as a trader, what your risk tolerance is, what you want. Do you want more money, or do you want less trades, or you want less trades but higher probability? Depends on your personality. The hottest cycles, guys, these things they're hot. I don't know what else to say. They're working really good. They're working really good on the S&P. It's been tracing this out almost perfectly. It's been tracing out gold almost perfectly. And we have, guys, the one thing I'm the most proud of, to be honest with you, of everything, is that I have kept everybody out of trouble on Bitcoin and the cryptos. I've been on top of this decline for months, and I've posted this on the solar cycle. I'm so happy that I've saved people from this, because we saw this coming a mile ahead of time with the Bitcoin, and the hottest cycle has predicted this thing. These hottest cycles have been like within a few days of the turns. So I'm very, very happy with the Bitcoin, because it's been a massacre for a lot of people. And I know a lot of people have never seen a bear market. a real bear market, so they just keep buying and buying and buying. But these things have cyclical patterns too, and we're in a seasonal pattern for Bitcoin. And I'm really happy about this one because I feel like a lot of people were able to get to safe harbor on this. A lot of the stuff that I do is to try to get you guys to protect your assets, and we're seeing this now in the crypto, and I think it will play out in the bigger markets too. But the crypto really has been getting hammered, and so I feel like we've done a good job with this. The new closing bell is up for the grains and financials, which I'll show you in a second. Streaming RSI rankings, which I just showed you. We have those streaming RSIs. I put them up in the day just so you can see a snapshot of them in the day. So that's there. Double lunar cycles, guys. I'm going to show you the websites where you can go. But these guys, these are doing so well, and they're just continuing to do well. And the top three that I really like to put together right now are the S&P, the 10-year bond, the 10-year note, and the Bitcoin. Those three are just really cleaning it up. Uh, I know there's a lot to talk about here. Big runs. I added for two ETF symbols. I added for the SPY. This is in the S&P service now. So this is a swing trade service. This is interesting because we've never had this with the S&P newsletter. S&P newsletter has always been more just like forecasting, talking about throughout the month, what are the hot spots of the month, what are the bigger trends. This is an actual service now in terms of stops and limits, and this is the SPY. The basis on this is going to be about $10,000 per trade. You don't have to trade that. You can do whatever you want. But in terms of the logs that I'm doing, I'm working with about a $10,000 basis on this. These have 2-day break evens. ETFs are horrible to model because they have gaps, and the gaps create noise. So this is why I stick with the futures, because futures have continuous flowing patterns where ETFs don't. Stocks don't. You can have huge gaps up or you can have huge gaps down. And what that does is that wreaks havoc on the optimization process. So this is why ETFs are so difficult to optimize. You have to, instead of a max profit type of a curve, you have to really look more at a low volatility curve, because when you get into max profits, you get these huge gaps, or you have stock splits, or I mean, just it's a mess. But we've added these two to the service, and they go break even after 2 days. And that's one of the other things I had to do to make these work. They have to go break even. So when a trade happens, you got 2 days to get ahead on the thing. If it's not ahead after 2 days, the trade's done. Okay, or if you're ahead, the stop goes to break even after the second day. It's a little different than the futures. The futures, we just let it rip and let it ride. I don't worry about the futures too much because I know that the data that's coming through is continuous, right? It's 24 hours a day. This stuff is not 24 hours a day. And so when you go to try to optimize it and you're trying to do all this look forward optimizations, you get a big mess. And so you get these great profit curves that don't pan out. So this is why it's taken me a while to do this. But okay, so we got one symbol for the S&P, we got one symbol for the stock ETF. This is an actual trading service. Okay, it's actual trades, like straight up trades, like limit stop. So that's for, I mean, some people that's what they want. Other people know, other people longer term investors, but it's there, and we're going to start small with that. So, and again, I told you guys from the beginning, these services continue to grow. Okay, so this is why I tell you guys, stick around from the beginning, because these prices always keep going up because we're adding more features to these services. I have a vision of where I want all of this to go, but we're slowly expanding out to that. So it's a process of kind of unraveling the pieces and moving slowly, because you can't just add features if you don't know if they work. That's the thing about this. But we know the big runs works. It's working for other symbols too. December newsletters have been out for a while now, so you can check those out. Code breakers, guys. This is a high probability play coming. It's going to analyze the code sequencing of the prior days, kind of like the code on a lock, to find out what the next day will be. It's a form of stochastic time series analysis. It's an advanced algorithm, the way that it optimizes. But the point is, it's coming, and it's going to be for platinum subscribers, and it's going to be a separate service. Okay, so next weekend, no webinar. So no webinar next weekend. So then the following week, we're going to have one on the 26th, which is the day after Christmas. So it will be another Sunday. So 2 weeks from today, we'll have our next webinar. We'll have part 2 of high probability plays. And then we'll do part 3, part 4. Probably part 4, we'll get into the code breakers. concept of what that is. If you're just joining the channel now, I'm Shane Smoleny from Wolftrader Futures, and we are talking today about high probability plays. And we usually go through the disclaimer, and then we give you news and events to try to let you know what's happening here. But we'll keep kind of moving through this quickly. Streaming RSI rankings, I do give this in the day, so I have these RSI rankings where I rank the different RSIs, and then I have what's called the best RSI value, where you get buy or sell pressure. Now, this best RSI, I'm thinking about swapping it for the polar R squared, which I'll talk about today. I'll show you what that's all about. And today's webinar is a technical webinar. So for those of you who like all the technicals of it, the Virgo stuff, like that's what we're going to talk about today. It's not so much big picture. I've been doing a lot of big picture lately, a big picture of the Fed, a big picture of the S&P. But this is going to be like drilling down today on some technicals. So, but that's coming, and then the code breakers would come like this every day. You would see all the symbols, and it would just say which one's on pace for the buy sell, and you're going to know the codes ahead of time. I would send you the codes for the month ahead of time for each symbol. And again, I want to do a lot of symbols. I was going into like sugar and the softs, and it was working great even on those too. So it seems like it's pretty universal. So yeah, I'm working on it, but I'll let you know. But it's coming. And that's exciting because different people have different things they want to do, man. Some people don't want to do portfolios. Some people want to do one-day trades. Some people love the portfolios. I love the portfolios, but some people don't. Some people want to trade these little in and out trades. Nothing wrong with that. It's just a personal preference. The greatest financials closing bell. So it's here. So it looks like this. So this is what we have right now. We have corn, bond, and euro dollar. Euro dollar has been giving us some data issues lately. I don't know what's going on with that. I got to fix that, but it'll get fixed. Big runs. So here's the status right now. We have S&P oil, gold, corn, Bitcoin all online, and then we have SPY, and Apple online. So these are growing. These are relatively long trades. They can last for 8 days sometimes, or if I re-optimize it, it can actually extend out. But usually it's three to 8 days on these trades. So that's going. Now the portfolio analyzer, I've talked about this before. This is available now for you to take a look at. So if you want to take a look at these, what I'll do is I'll show you. We've updated the S&P, Bitcoin, and the 10-year, and I want to show you how these are doing. So what I'll do is I'll take you here. So this is, if you go to the actual website, I'm going to try to get this in the picture here. You will see there's the home button here, and then there's something that says Wolftrader Portfolios here, and then pricing plans, auto trading, platinum, and these are the logins. So right here, when you click this on the portfolios, what this does is this opens the page here where I have the portfolios. And so the idea here is that I'm going to put, what are the most recent portfolios for the double lunar cycle. I have a disclaimer here, which is very similar to what I just read you, but just essentially stating that this is risk, and that these are not necessarily reflective of slippage or commissions or things like that. There's other market conditions that can create problems when you're getting into trades. So just kind of putting that out there. These are published though. This is all published and timestamped. We can go back and search that history if we need to. But if you go in here, you'll see this is the double lunar cycle here for the S&P. This is the first one here. If you click the image, what it does is it actually zooms in for you so you can see it. You can see here the S&P just closed out a very nice trade here of about 120 points on the long side here for the double lunar cycle. It had this one little dip here, but this is adjusted for micro contracts. So just to clarify, before I have had some full contracts in there, this is micro contracts. Again, all published, all given to subscribers. The crazy thing about this, and I'm going to tell you what's crazy about this, is that all of these trades are known a month ahead of time. Believe it or not, guys, these signals don't even look at a chart. They don't even look at support or resistance. Today, when we look at the high probabilities, we're going to look at charts. We're going to look at the regression concept. But this is just, I gave you these at the beginning of the month, and look at what they're doing. So you can get the statistics here. You can zoom in. Now, let me talk about the concept of the probability here. So this concept here, zoom in here, this is a 56% chance of success here. Now 80% of these are to the long side. most people, when they think of markets and success, a lot of times they think, not most people, a lot of people who don't know about markets, they say, well, it's like a coin flip, and if you can do better than 50% of the time, then you're really doing really well. That has nothing to do with anything. When you're talking about a coin flip, these Bernoulli trials, that's the worst possible way to think about the market because it doesn't take into account many other factors. Many times when you get the best systems, they're only going to run about 56%. Bitcoin runs under 50% and it makes money. So this is not a high probability system, but it consistently it's chugging along here, kind of doing its thing. The goal, look at the 10-year. The 10-year note is going to be uh, continuing to plow higher here. Just really just has been on point in the last couple of months. And again, this has to do with our optimizations and the way that we optimize this stuff. It's getting better. Again, all published data, all given at the beginning of the month, guys. All of these trades were handed out to you before the month started. It's kind of spooky if you think about it, but it has to do with how we optimize the algorithms, and it's a whole process. It's actually 3 different layers that we put on this to get this accurate like this. And then you can look at the plays here again here with this, and yeah, so it just gets into this one is 62%. This one's pretty high. Actually, 62 is really high. For a long, so let me qualify this. 62% is really good for a system that's alternating long and short, long and short, long and short. If we're talking about waiting around for that perfect trade, that's 80% probability. Yeah, but this one's going to make more money because it's going to trade all the time. So Bitcoin, here's Bitcoin. So it has this dip initially here, and then it has this nice run up here. So that's about 4,200 on the micro contract. That's since last March. So yeah, again, all of these published data in the newsletters, published and timestamped on Twitter. You can go back and search that if you need to. So this is the combined portfolio. Oh, by the way, I do want to point out Bitcoin actually has a 46%, 48% probability here actually, 48%. So that's a losing if most people looked at that and said 48%, you think you're losing money. It has nothing to do with the percent. So I'm doing high percent today, but it has nothing to do with the reality of portfolios making money. Okay. Some of the best traders in the world, Stephen A. Cohen and all these, have like 20% success rates, and they make because they wait on these asymmetric trades. So percent is really not a good statistic to look at. Okay, so here's if you put them all together, and this is what I'm trying to get at with you guys. That I want you to look at these as a unit. Okay, so these are 3 together. This is the S&P, the 10-year, sorry, S&P, Bitcoin, and the 10-year together. And this is the portfolio here. So this is up on 3 micro contracts, a little over 18,000. So they're averaging about 6,000 combined. And, again, this is only 56% probability. So yeah, it's a balance. It's a balance. This is a delta neutral strategy. So delta neutral means it doesn't matter the direction of the market. It's always long and short, long and short, long and short. So for those of you who are involved with designing systems and designing trading systems, mechanical trading systems, you can appreciate how difficult that is to get those numbers. And again, this is all published data. This is not a back test. This is what we publish to subscribers. So that's the portfolio. Go there and check it out if you want to. And yeah, so that's what's going on with that. Okay, so we'll get, yeah, I think that's enough on the portfolio. I did whole webinars on the portfolio. You can go back and look at that if you want. But I think I love the portfolio concept. I just think that's you can scale it's scalable too to large accounts. It's scalable to small accounts. If you trade it with ETFs, you can scale it down. You can scale it up. The trades last days, so you're not worried about slippage and commissions and trading 30 times in a day and all. None of that stuff comes into play. And when you're talking about like the S&P had a 120-point run, just this last long trade that it made. I mean, you're talking about that's serious, and you're talking about a $3 commission on that on the micro. So I mean, it's got a lot of advantages, but there's a trust factor. So it depends on your personality. If you're a person that's low in trust, you're going to want to go more for the high probability plays. I'll get into that. It's the personality traits. It just depends on the person. Um, but this trade right here, it jumps from 2,800 all the way up to 3,400, right? And that's a micro contract, but that's, and that's the thing. It's kind of I don't want to show the chart here because I don't want to give away too much information with the actual signals, but it's kind of spooky that this thing goes into a buy in late November and just goes into a sell now. And somehow it knew that that was and it went through all of that garbage. We had all of that volatility back and forth, and somehow it knew that it was going to get out on the 10th. And for those of you who are subscribers, you know what I'm talking about. You guys have this information ahead of time. This is not, made up after the fact or optimized or none of this stuff. This is all published at the beginning of the month. So that's it's kind of spooky, I guess is the word for that. But look, we're here to make these better every month, and that's where we're going for this. So anyway, so that's the portfolio. We have different ones too. I'll put up there's Fed juices, and there's the code breakers will go up there too. What's up, old gringo? Well, we got a lot of people here today on Sunday, man. This is great. All right, so enough of the portfolios, guys. I just wanted to bring that to your attention. If you want to check those out, I think I'll probably make it so you have to at least be a free subscriber to see it, but whatever. Go there and check it out. I'll post them, and those represent the best systems. I mean, they don't all do this well, so just to clarify that, I just kind of want everybody to know that. But anyway, all right. High probability plays. We're finally here after going through those portfolios. So let's talk about high probability plays. High probability plays. Um, so high probability plays focus on short-term patterns, except for if you're short volatility, because short volatility is it's a high probability play, but it's kind of like fool's gold type of a thing. But most of the things I'm going to talk about here are very short-term patterns, like one day trades, right? So today we'll focus on a short period of 1 to 3 days. Now, the thing about this is that you have to balance out probability with the number of trades with the net profit. Okay, and you'll see what I'm talking about here, because you can get really high probabilities, but you might only get like 2 trades in a year or something, right? So you don't want to get too high probability. You want to get enough trades, and then the net profit comes into play where you want to balance that out too. So it's kind of, we're going to look for saddle points on curves. So I'll explain that to you when we get there. There's saddle points on profit curves where you get to see, hey, what's up, Angelo? Oh man, we got a lot of people here today. Yeah, people from all over the country. Um, so we got to look at what's called saddle points on curves, and the saddle point is basically it's a profit curve. When you get saddle points like this, let's say you have probabilities like this, um, and let's say the probability out here is like 100% out here, and then as you get out, the probability becomes less. So you'll get a saddle point like this, where it'll go like this, and then it'll go like this, and you'll get these profit places where the profit spikes and then it falls off, and it spikes and then it falls off. And so you want to try to find the most stable region on that saddle point. And these can get like three-dimensional, and it gets all, plotting and scheming, and it's whatever. It can get ridiculous with the amount that you can start getting into this. But the saddle point is important on this. And so that's also there too. So you must battle this. I would put, you must balance the saddle points into here too. I would put saddle points into here, which we'll get into that. But again, this is very much cloak and dagger trading. Um, Cloak and dagger trading is dealing with, you're like in there, you're waiting, and here comes the trade, and you're plotting and scheming, and it's the target, and it's all this stuff. And it's like that's not what the portfolio stuff is. The portfolio stuff is just you're in it all the time in all the systems. Okay. Um, so again, this is cloak and dagger type trading. All right. So who are high probability plays good for? So this is a personality thing. So uh, first of all, I would say fearful traders. If you're fearful about taking a loss, if you don't like to take losses, if you want everything to be just right, um, this fits the personality of a like a fearful trader. Also, skeptical traders, like people who are skeptical of the markets, skeptical of trading systems, skeptical of holding a trade more than a day, skeptical of the markets, skeptical, all of this stuff. The market is it's random and all this stuff. Just skeptic, 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 right? So that's really good for these types of people because they don't believe in anything. They just it's all regression and that's what it is, and it's all random according to them, right? But we showed you on those plays that it's not random, right? We showed you on those S&P plays that with this portfolio that it's not random. We forecast this a month ahead of time, but that doesn't mean we still can't do the high probability trades, okay? It depends on the person. There's people that their whole life is built around talking about how the market is random and they're going to play these high probability spreads or, shorting volatility all the time because that's the only thing you can do because the market's random, right? Okay, fine. Let's talk about this. So I put this in here too. So traders who need self-esteem to the self-esteem boost of consistent winners versus a series of small losses and big runs. So this is important. So a lot of times when people trade spreads, right? They love spreads because spreads have a high probability of success. So it makes you feel like you're successful. You're always making little gains. You're always doing well. It makes you feel good about yourself. And there's nothing wrong with self-esteem. It makes you feel, you're feeling like, hey, I'm making progress here. Whereas in reality, the big plays come with a series of small losses and the big runs. And a lot of these big hedge fund managers, Stephen A. Cohen's famous for this. He makes these asymmetrical plays and they're willing to take these small losses all the time and look like nothing's happening. And then all of a sudden, boom, the big play comes. So if you like to have a bunch of little consistent gains, but you're not necessarily, you know, you can't handle loss, 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 boom, big winner. Or when the boom, big winner comes, you take the profit too fast, right? You don't have the discipline to let the big run go, then this can be good, right? Regression analysis traders, people who love to just talk about regression, these are good. Uh, the market is random people, those people who think it's random. This is really good because they're just saying, well, it's random and it's just, X standard deviations lower or two standard deviations, they get on to all of this rational mindset. And the last one that I would say is people who think of themselves as rational people. Um, this is a problem because people like to fancy themselves as being like I'm so rational. I'm just and we know that that's not true. Like you're ruled by your unconscious and emotions, and but the more people that tend to get into this mindset, a lot of times this can be like scientists, engineers. I'm just rational, and everything is cut and dry. It's black and white. These types of trades are good for those people because they don't have much trust, and so to have to trade portfolios to let trades go 5 days, 10 days, 20, these signals, you have to have a level of trust to do something like this, right? To let these portfolios flow out. But if you don't have the trust factor, then 1 day plays could be great, right? Because it's like, hey, it's just 1 day, right? Are high probability trades always the goal? This is a question here. So you might say, yeah, of course, that's what it's all about, right? No, it's not. It's not. I just showed you here when we looked at Bitcoin. Bitcoin had an under 50% success rate, yet the profit curve rose. The goal is dependent upon the individual needs of the investor or the trader. Okay, so this is highly individualized, and the highest probability may not offer the highest returns or even lower volatility returns. So just because you're choosing a play that's 80% successful, you could have 1 day where it just goes off the chart wrong. And so the volatility could still be really high, even though the probability is high. So that we got to be careful with that. Higher return trades are generally lower probabilities, which I just showed you with their portfolio, than high probability systems. So you're not going to make as much money if you go for high probability trades in the long run. Low volatility returns might be an even lower probability. So if you want a profit curve that's even a lower volatility, you're probably going to have a lot more little tiny losses all the time. So when I talk about probability, I'm talking about um, that it doesn't matter the size of the move. It's just what's the percent winners versus the percent losers. But that's not really a good way to look at it. So one more slide here, and then we'll get into some visuals here. So isn't the goal to be better than a 50% coin toss? And we're talking about Bernoulli trials. I mean, this is like the biggest fallacy that you could get into when you're talking about the stock market. So no, that's not the goal. The coin toss is a terrible analogy. We're talking about Bernoulli trials. Coin toss does not account for the size of the winners. It does not account for the size of the loser. When you're flipping a coin, it's equal heads, equal tails, equal heads, equal tails. Um, it doesn't account for the volatility. You know, you could be doing great probability and then the volatility spikes and you caught it on a loser, right? And so when you go back here to the S&P is the perfect example of the double lunar cycle here. This is going along here fine, right? And then it loses here, but the volatility went through the roof. So it lost on a high volatility trade. Okay. So so you might be willing to think at that point, man, this system is terrible. I've been in this system for, I've been in this system for 6 months now. It was chugging along, and then whammo, one big trade comes, and now you're actually you're almost underwater. What a waste of time, right? And so psychologically, these are the games that people tell themselves, and people will talk themselves out of a trading system. And this is where we get back to the concept of trust. Trust. You have to have a level of trust with what you're doing, and a lot of traders don't have that. And that's nothing wrong. Like if you're a defensive minded person, like in sports, if you're defensive minded, you're going to be like defend, 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 defend. But the reality is that the system did come back and recover, and it went on. And so, do you trust in the system, or are you just going to say at this point, no, 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 no. One trade, look, it all got wiped out in one trade. No, 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 no. But this is what it is. It is what it is. It's the system. Um, so that's what I'm talking about there. When I get into that slide here, guys, I hope this webinar isn't too long today. I got like way over analytical here. Um, but anyway, that's what I mean when I talk about the volatility of this here. So look, coin toss is it's like flipping. Like, I mean, think about like you're flipping. It's like I see this on commercials all the time. Like, can you imagine if you could flip more than if you could just have a 51% advantage, you could take the house or take the casino. It has nothing to do with that. Let's say that you had tails, heads, tails, tails, heads, right? And you're just kind of going along here, and it just you're flipping coins, and then all of a sudden, one coin flip, you get 10 tails, right? That's what happens when the volatility expands. See, the coin flip thing means nothing. It means absolutely nothing. That's what happened in the S&P, but the system was good and it came back. Lurking variables. Guys, this is a big one. Volatility is one of them. I put that in there. Swan events, fat tails. The Fed, we know what the Fed does, guys. I show you this every day for subscribers. Cost averaging is a lurking variable. You're pretending like everything's fine when it's not fine, right? You're just averaging your price up. You're averaging your price up, right? And then it gets really bad. That's another problem. That's a high probability play that people try to pull off. They cost average in. They cost average in. Oh, look at my portfolio. It's doing so good. Like they show this portfolio with all these winners, right? And then all of a sudden it just goes off a cliff like this, right? Because you're cost averaging. It's like that's not real. It's a lurking variable. So some of the best traders in history have had a low probability of outcomes. So we've seen some of these best managers have like 20% success. But they have the discipline. Look, when you're trading long volatility or long options, okay, you have to have the discipline to keep taking small and tiny trades, small, 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 and then when it goes big, you gotta have the discipline to let it go, to not screw it up and to pull in profits. Okay. Okay, another one here. Some of the most famous hedge fund blowups had probabilities more than 90%. So the opposite can be true too. You can think that you're doing so well. You can say I want a high probability fund that's 90%, right? And you can have 90% winners, low volatility, right? And then it's betting against volatility, right? And then the fund blows up, right? So, look, it's very tricky to look at this and understand what's going on when you just see probability. It's just not a good definition of what is going on. But today's webinar is going to be on high probability. So I just wanted to kind of put those disclaimers out there to kind of give you the playing field that there's many ways to do this. And there's many if you study many of the most successful traders, they all have their own idiosyncrasies, and sometimes they go against the convention of what they should do. So, okay, so let's talk about the polar R squared. Polar R squared is is an optimization. It's an indicator that I've developed. It's like an R squared, but it has direction. So an R squared value goes from 0 to 1. So if the trend starts strengthening on an R squared, what happens on the R squared is, like, let's say that our market's going like this, and all of a sudden it starts to trend like this, right? Let's say this is a market across time, and this is time down here, right? So what happens with the R squared is the R if you look at the R squared value, I'll just put R squared there. Well, what happened is it gets up, the maximum is 1, which is a perfect correlation to a linear line, and then 0 means there's no trend, right? So if the market is waving around like this, the R squared will be down like this, but then all of a sudden it'll start getting strong like this when the market gets into a linear trend. The problem is the R squared doesn't give you a directional analysis. So the polar R squared is polarized. It tells you the direction of the market. It's better than an R squared. So that's the regular R squared. So the polar R squared will actually go negative when the market's going down. So it ranges from -1 to 1, where the regular R squared ranges from 0 to 1. Now this is something that I've developed. We only have this indicator. Low values correlate with bullish reversals, particularly on the S&P. We're going to talk about that today. We're going to talk about some actual graphs to look at that. So here we go. All right, so let me explain to you what this is. This is the polar R squared as it dips down. What happens to the market the next day, okay, in a one-day trade. So this is down all the way down here. This is negative. Let me put this here so you can see it. Again, guys, this is a technical webinar. I know it's for those of you who are big picture people. You're like, what is this? But we're going to go technical today. So this is -1 over here. This is all the way to negative trend. This is 0 here. It's positive trend. So basically, when this thing gets really, really low down here, this is the percent. This is the percent profitability here. This is the percent profitable. This is the percent. So you can see it gets up to around 80% here. This is about 80%. This is the peak here. Okay, so 80% of these trades are winners when it gets down to this low level. This is S&P. I'm looking back about a year, about a little bit more. But notice this is the profit curve here, and the profit curve doesn't start peaking until you get out to around here. Okay, so in other words, it has a more shallow dip. This is called a saddle point, and I talked to you about this. So you have to see this stuff visually to understand it, but there's regions on the saddle which you have what's called a stable point on the saddle. And so what you want to do on the saddle is it's rounding like this, right? So you want to find a point on the saddle that's kind of like in a stable. You don't want to be right on the edge here. You don't want to be right on the edge here. Although this is probably better to be on this edge because it's still climbing. So this is where you would want to be into here. So this is the first saddle point. And notice the percent probability starts dropping. So down into here, you get down to the saddle point, you're into the 60s. You're like 69% profitable down into here. But you make the most money. So you're going to have to tolerate more losers into here, but you make more money. And it's a lot more money. There's another saddle point over here, which is higher over here. Now, I don't like getting into saddle points out into here because this is S&P has been in a bull market. So there's multiple saddle points. Because the market's been trending higher, it doesn't have to go that low to reverse, right? But if you want a higher probability, and that's more statistically stable from a regression standpoint, you're gonna have to be out here, okay, on the left side of this. And so that's the visual of this. We'll look at the actual probability of this next, and I'm going to show you some examples. So here's the saddle here. So this is the money. So you can see the difference here. So this is the money. So if you're trying to just get a 90 or 85% trade, you're talking at about somewhere around $6,000 here, right? On about a, I would say that's about whatever that is. That's probably, I think I don't have that probability here. It was probably like 70% or something. But if you keep coming over into here, notice that your profit goes from 6,000 all the way up to like 26,000 here, right? So if you can tolerate a slight drop in the probability, the profitability of, sorry, a slight drop in the probability of the trade, then you can make a lot more money. So in other words, you shouldn't be stubborn about saying, I want the 95% winner, because you're not going to make that much money. But if you can tolerate a 69% winner, then you might make more. So I'll go back here to the probability. So this first point here, so just to reference, this is pushing probabilities up around 80% here. But you're only looking at about $6,000 down here. It's not that much. And then if you can come a little bit up here and you get down into probably like 68%, that now you're greater than $20,000. And this is on the full S&P contract. But so it's kind of like a balancing act to figure out, well, do I want to deal with more losers, or do I want to make more money? Like, what do I want to do? It depends on the person. I mean, if you're somebody that doesn't want to deal with any losers and you'd rather just make less money, but then you want to be down here. But I think the first saddle is a good point to look at, and usually you get these. And if it's a bear market, it's usually the other way. But you're going to get multiple saddle points, especially if you're dealing with a bull market. So yeah, that's the first one here. So that's a visual representation, and this is very straightforward. I mean, it's like it's over. It's X standard deviations outside of the mean. Everybody can put their mind around this. This is just basic regression analysis. But I'm looking deeper into the curve to help everybody understand. Look, it's not just about picking the highest probability. There's a point here, there's an optimization point on that curve where the first profit peaks and then it goes down and then the next one comes up again. So that's what that is. So let's take a look here. So this is an example here of the polar R squared, and this is, if you're only looking at the 80% probabilities here, this is what this is here. This 80% probability. I just picked this one. So 80 was about $8,000, 10 trades. Not that many trades across. This was across like a year. You can see the trades when they come. I don't know if you can see this. Hopefully you can see this, but there's not too many of them here, but they tend to generally be winners. But they don't show up that often. You don't make that much money. But you can say, hey, it's a very high percent success rate. So that's what it is. And again, it's all getting back to the concept of trust, personalities, and how much you trust and how much you don't trust. And this is what the profit curve looked like. So there's not that many trades, and you're going back about a year, it just doesn't trade that much. There was a cluster of trades I just showed you, but you could go for months at a time where there's no trades. So, you want to be sitting around doing nothing? Okay, that's fine. But you're going to get months at a time here. So this is 3 of 21, and this is like 9 of 21. So you got like 6 months here where there's nothing happening because you want an 80% trade, or whoever wants an 80% trade. So just something to think about. And again, there's no right or wrong to this, to be honest with you. Like, depending on the situation or the market, some people may only want to trade 6 times a year. So yeah. Okay. So Gary says, thanks, Shane, for when I need specifics. You have so many options. This is a deep dive. How to use each system is a huge show. Yeah, no problem, guys. Look, one of the reasons why I'm looking to revamp the aspect of our service that focuses on high probability trades. So there's a subset of traders that all they want to do is a 1-day trade. They don't want to do a week or 2 weeks, even though the week or 2 week trades are making very good profits. So I'm revamping. So this is one of the polar R squared. This is going to be coming into the mix, and it's going to probably show up on every chart. So I'm just giving you like a background on this. Okay, you can see here on the chart. I don't know if this might be really hard to read, but let me just explain to you what this is. This is a profit graph here. So if you're looking at 80% profit here, you're looking at about $8,000. So that's 80% there, and that's $8,000 or 83.25, somewhere into there. Okay, so that's what that is there. And we showed you on the saddle what that looks like. So you're on that side of the saddle. If you go down here, though, if you go just down to 77%, if you get down into 77.8%, just a little bit less. I mean, think about that. You're not even 3% less, right? You're minus 2.2%, somewhere into there. If you just take a few percentage points off the top there, look what happens to your profits, right? You go up to 14,000, right? So this is where looking at that curve matters, and not just going to the highest profit and going click and clicking that one, because look, just for a few percentage points lower, you had a sizable gain here. Okay. So looking at the data, getting deep inside the data, it matters when you're talking about this type of stuff. And this is cloak and dagger trading, guys. This is like, waiting around and plotting and scheming, and I'm going to wait here. And when this happens, I'm going to go here. And then my limits here, my target, you know, opposite of the portfolio. But again, some people like this, nothing wrong with that. It's your personality type. That's all. Everybody's different. Remember the saddle that we talked about? So I'm going to go back here. Remember this saddle here on the curve, the saddle point. So this is what the saddle looks like on the data here. So I know it's hard to read, guys, but what this is saying here, this is basically goes from 10,000 here, and then it jumps to 20,000 here. You see that big jump right there? So it goes 10,000, 20,000, and then you're getting into here like 28,000 here. So that's the saddle. So it's going like this, it jumps up like this, and it goes up to the 28,000 like this. So identifying the saddle, and your probability did not change that much, right? It changed a little bit, but not that much. Yeah, actually the saddle it's also here. That's the gross profit. The net profit actually shows up over here. It goes from 14 here, and then it goes to 20, and then it goes back to 13. So that's the profit there. So you go from 14,000, you go up to 20, and you go back to 13. So there's your saddle point there. So you're going to look for a stable point on the saddle. That's somewhere like in the middle of the saddle. I mean, that's the ideal situation for that. So I mean, these are the decisions that go into this. When I'm going to start posting these on the daily charts, the polar R squares, that you're going to understand, like, where does this come from? This is where it comes from. It's a deep dive into what the curve looks like, and every market's different, guys. And because the S&P, oh man, this is going to be a long webinar. I hope you guys can stick around for this because we're not even close to being done yet. But saddle points, because the S&P is in a bull market, you got two saddle points here. Okay. Got saddle 2, saddle 1. I don't want to deal with this one. This is caused by the bull market. This one is more likely to regress off the low because it's so overstretched, even in a bear market. Now, you can get situations in bear markets where it can sit down here for a while. That's the only risk of like a bear market or dislocation. But we're talking about normal market conditions here, and these are one-day trades. These are not, just one day. So notice, so when we go to this next one here, so this is going to be the 77% play here, 77%. And so you go to 14,000, you got 18 trades. So now you're getting more trades. You compromised on your probability by about 2%, 2.2%. But look at how your profit jumped, right? You jumped up to 14,000, and now you have 18 trades. These are one-day trades. Here's a long trade here. 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 But these are two losses into here. So now, notice your losses are starting to increase because you're saying I'm willing to take some losses to make more money. Visually, what does this look like? Everybody can understand oscillators. Guys, the stuff that we do here is so unique and different that sometimes people can't relate. Like, how could a lunar cycle make all this money a month ahead of time? How can that be true? Or how could the Fed juice be causing the market to go up? This is something everybody can see, and they can all nod their head and be like, okay, regression, I can get it. Even if the market's random, okay, I can get, So I think a lot of people look at this and they say, I can relate to this, right? So visually, what does this look like? Well, here's the line down here. This is the line down here. And so I adjusted it. So each time this gets down, it dips down into here, you generate buy signals. So here's your buy here, here's your buy here, here's your buy here, here's your buy here. And then when it gets above it, there's no more buy signals. It gets down here, here's your next buy down into here, it buys here. It dips down into here, here's your next buy here. This one dips down, barely makes it this time, and here's your buy here. Okay. So each time that we're lowering the percent, this red line is going to go up. This is the floor, right? So notice, I want to show you something. Notice here, it comes down here. You see this? But it doesn't quite make it, and it didn't catch that long trade right there. You see that? It didn't catch that one because we're being a little more picky. We're saying we want 77% chance. So you can also miss opportunities too. This one makes it, this one makes it, this one doesn't make it. Notice this one gets kind of close. Didn't make it though. This one made it. Look at this one. On the recent decline, it didn't make it. You see this? You know why it didn't make it? Because the market was stair-stepping like this, right? Stepping like this, right? And so these indicators, particularly regression analysis, it kind of acts like the area under a curve. So you have to really be stacking in one direction for a long period of time to push these things up like this. You see how they stack, 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 stack. You get up, you get up, you get up like this, right? This wasn't stacking. This was like stair stepping. And so that's what happens. And then of course it hooks up really quick here. When it hooks up here quickly like this, you can get divergences, right? And that's where divergences come from, hooks, wild hooks. So be weary about this, okay? That we're not talking about Fed juice today or any of that stuff. So sorry, we're we're talking about technicals. Like this is all that I do all day. I do like the hardcore technical work when I'm coming up with these systems and writing code and optimizing and trying to understand the statistics and the curves. But that's what this one looks like. Okay, so 77%, 14,000, 18 trades. So we went up, right? So we went up on the number of trades, and I'm going to go back to the previous one. We went up on the number of trades, and so we had 10 here, and we 8,000, 80%. But this has 18 trades, right? And it's $14,000 and 77%. And that's the line down there. That's where the trades happen when it hits that line. S&P has been like, it's spooky how good that is when it hits down. And part of that is the Fed, guys. I mean, when you're in a bull market and that thing hits that line, it's coming right back up. But now that could be changing with the taper. So that's the only problem too. If markets change their characteristics and you go from a bull to a bear, these oscillators can get hung up on the low end. So that's a challenge too. But notice how the profit curve worked. First we had almost no trades for 6 months. And now we're starting to get a few more trades in between, right? We'll look at one more scenario here. Now I'm going to go down to 77% probability. Okay, 77%. So we've gone from 80 down to 77.3. Now I want to show you how nuanced this is. This is like really detailed stuff. This is all Virgo stuff, guys, what we're doing right now. This is like detail. Notice that you're 77.8% here, and you're at 77.3% here. So we only came down a 0.5%, and our profit jumped jumped to $20,000. So you go from $14,000 here to $20,000 by giving up a 0.5% of probability, by saying I'm willing to tolerate a 77.3% chance of probability, and you got 22 trades. Okay, so you're getting into fractional values here, these fractional values that can make big differences in the sensitivity, because it can come close, like we saw here, right? Remember, it comes really close to crossing the line down here. Remember before it missed it? Well, now it catches it, right? So now it catches it. These are 1-day plays, 1 day. This is for the skeptical trader, the pessimist, the market's random person. This is for that personality, okay? All right, so you get down into here, down into here, you get down into here, right? S&P has been phenomenal for this because of the Fed, because the Fed just keeps coming back in and bailing it out. But it works on other markets too. I'm going to show you Bitcoin in a minute. But just to look at the curve here, so if you go down to 77.3%, now your profit curve, you're starting to get a few more trades now throughout the year. You're not sitting for, I mean, you still sat here for, God, like 4 months, but yeah, okay. But it's a nice visual because you can kind of see this. You can see this like coming from a mile away. It's not like, you could see it's falling, it's getting down there, and then it finally hits below that line. The only downside of this too is these indicators can flicker sometimes, or it could be one way at 12 o'clock and then another way at the close, and that's kind of a pain. Whereas the double lunar cycle is like there's none of that flickering around. Like you guys know what these trades are at the beginning of the month. Like I have given you the trades at the beginning of the month for this system. There's no, oh, is it going to make it today? Oh, is it hits resistance? What's this support? It's none of that. It's just these are the trades. So, but again, this probability stuff, this is all regression stuff. So And again, I think people can appreciate this. I think they can understand it, even the skeptics out there. All right, so I'm going to go up to that other saddle point that I talked about here. This saddle point up here, guys, I know this is getting long, so I'm going to try to speed this up. So um, remember, there's another saddle up here, right? There's another saddle point up here, and yeah, it makes more money. It makes a lot. It makes a lot more money. Well, it makes 50% more money, but I'm skeptical of this because if you go into a bear market, it's not going to work. Okay, so let's see what that looks like though. So you get up here, this is the next saddle point into here. So here's your next saddle here. So you're in the 41,000 to 44,000 here. That's your next saddle point, right? So you have the first one, here's your next one here. This is 44,000. And so, like I said, some people get three-dimensional with this, and we can do that, but it's beyond the scope of this webinar. Um, here it is, but now you're down to 67%. I mean, it's still okay. But if I'm going to be 67%, I'd rather have a portfolio system, to be honest with you, because the portfolio systems always have trades coming and they're always hedging. This stuff isn't hedging. It's one day and you can get smoked. And if the market turns, you can get really smoked. Bad. So this is what it looks like visually. Notice there's a lot more losers in here. So the line, notice how high up the line comes now? The line comes all the way up here. So now you're only at minus 21%. Remember the polar R squared goes from 1 to 0 to -1, right? Down here. I didn't draw, I can't see that. Okay, so 1, 0, -1. So look how high that line comes up. So every time it dips below this line, the polar R squared dips below, you get all these buys into here. This one barely touches, you get a buy here. And as long as it's below there, you just keep buying each day. You see that? So that's like 3 days here. But look, it caught a bunch of losers here. Loser, 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 winner. Right? And then it gets above, but then here it dips down here, winner, winner. It dips down here, loser, winner, loser, winner. Okay, dips down here. This is winner, winner. It dips down here. I can't see that one, but it dips down, and then etc. So um, I'm not too big of a fan of getting into the 60s on a regression play, to be honest with you. It's just, yeah, I'd rather be up there in the 70s and the 80s, but that's what it is. And so what does this curve look like? Well, this one's starting to look a little bit more like a regular curve, like throughout the year, like it's steadily rising. So that's just an example there. Let's look at Bitcoin now. Bitcoin on the buy side. Again, I'm just looking at the buy side of these. I'm not looking at buy and sell sides of these. So Bitcoin again has two saddles. Okay. Bitcoin's in a bear market. I don't care about this saddle. Don't care about it. Not even a little bit. So here's your second saddle. Here's your first saddle. This is the one that I care about. Um, here is the minus 80% here. So, all right. So remember, the polar R square goes from -1, and then I don't even go past 0. 0 is like over here. 0 is here. So this is really, really low. This is almost like a straight linear trend down. So you're looking at about, this is the percent profitable. This is pushing up into the high 60s here. So Bitcoin can only get into the high 60s. That's what it can, that's the peak it can do. So this is the peak here. So this is your saddle. So wherever you want to sit on that saddle, the only problem with the saddles that I've seen, you don't want to like try to sit like right here, right where the peak is, right? Maybe a little bit on this side because sometimes saddles look like this, right? And sometimes saddles look like this, right? And so you definitely don't want to be here. If it's flat like this, you want to try to be in the middle. So maybe somewhere over here would be a good place for that. And so you're still pushing, pretty good probabilities. Again, second saddle, stay away from it. Stay away from it. Because we're dealing with the theory of regression here, pure regression, okay? All right, so let's keep going down here. So again, this is about $15,000. This is the full contract of Bitcoin, not the micro. Okay, so what does it look like? So here's what it looks like. So we're going to look at 67%. That's the best Bitcoin could do. S&P did better because the Fed is in there all the time, but probability 67%, 44,070 trades. So this one traded quite a bit because it's in the 60s, right? But here's a trade here. So it gets below this level here, okay? 1 day long out, gets below this level here, 1 day long out, gets below this level here, 1 day long out, gets below this level here, 1 day long out, gets below this level here, 1 day long out, okay? But it has some, it got smashed here pretty good on the downside. Look, lost here, one here, lost here, one here. Because when it hits that bear market, I'm going to get out of the way so you can see this here. When it hits that bear market, you can see that it gets down here and it'll stay down there. It'll walk down there. And so this is the problem when you get a severe downdraft. So these types of regression plays get into problems with that. But this isn't like the stochastic. The stochastic can stay down there. So if you've ever seen a stochastic, stochastics are not really oscillators. They're meant to be like when they get below that 20% line, as long as they stay down like this, a stochastic stays like this, that's a downtrend. Stochastics, when I'm talking about stochastics here, I don't want you to confuse what I'm talking about here with a stochastic. And I don't want you to confuse a time series stochastic analysis, which is what the code breaker is, with the stochastic indicator, because they have nothing to do with each other. Stochastics and statistics is not a stochastic indicator, but I digress on that. All right. But the stochastic concept is it's not really an oscillator. People think it is. It's not. When the stochastic gets down here and it stays down, that's downtrend, downtrend, downtrend until it crosses up. This is not like that. This doesn't stay down forever. Not like the stochastic. It tends to bounce even when it gets into a really pronounced uptrend like this, because it's modeling the R squared. It's going to come down quicker like this, whereas the stochastic would have just like stayed up there. So I don't want to confuse those two. But the basic idea is that this thing gets down and hits a threshold, and we optimizing what that threshold is, and we're going to look at the saddle points, and we want to know what level should I place that polar R squared at. So when you see it on the chart, right, when you start to see this on the chart, and again, I'm probably going to replace the best RSI with this. I'm just kind of going in that direction. Although the best RSI, it's kind of like I'm on the fence with that. But when you see it on the chart, you'll know when it gets below that line that it's a buy, right? You'll know that. Or when it gets above that line, it's a sell. But we've gone through the analysis of this to find those points to figure out what's the best option here to maximize that. So what does that curve look like? That's what this profit curve looks like. Bitcoin had a little bit of a smackdown here with the bear market, but still was managing to kind of dip back up there again too. So, but when you get into a bear market, you can get a smackdown. You get smackdowns very, very quickly on these. Even a 1 day system can give you a smackdown. So that's the other thing too. Like high probability doesn't tell you what the drawdown was on one play. It doesn't tell you that. It just tells you the probability. So this case was in the high 60s. All right, so high probability continued, not next week, next time. Yeah, next time, 2 weeks. So in 2 weeks, we will continue our discussion on this. Today was the polar R squared, but in 2 weeks, we will talk about the day percent statistics. My favorite for these statistical percentages. This tells you the days of the week that have the highest probabilities for each symbol. This is a bread and butter. This is the most solid statistical short-term indicator that I have. People love it. It tells you the days of the week. It ranks it. It tells you the percentages. That's a whole nother webinar. I would also put in here, I would put like spreads in here. We'll probably talk about credit spreads just because that's a high probability play. I'm not a big fan of spreads. Only time I like to do spreads is like when they're out of the money. If they're in the money, I think you're better off just doing micro contracts or something. But everybody's got their own reason. I mean, some people are hedging, and it's just different needs. But I'll talk about credit spreads. But it's okay. Credit spreads are okay. Like it ties. There's commissions involved, and it's just got to wait, and there's this. This is 1 day plays typically. But then finally, we'll talk about the code breakers in probably about 4 weeks. For those of you who are platinum subscribers, I posted a video in Nerd's Corner. So for those of you who are platinum subscribers, if you like this kind of technical stuff, this techie stuff, there's a new section of the site coming. This is for the platinum. It's called Nerd's Corner, where all that I do is I just kind of, it's like a videos of me musing through technicalities of, what's going on with this indicator and this optimization, and why is this doing this, and why is the system acting this way, and how can we improve it, or what's an idea. And I was talking about the code breakers the other night about what if you had a combination of a code to the market, and you could break that code of how it's behaving. So Nerds Corner is there if you want to. Well, I will be discussing more of this code breaker stuff in the Nerds Corner. But again, not everybody wants to talk about these technicals, so I understand that. Some people just want big picture, and that's fine too. Let me just go here. Shane, is there a service that clearly spells out specific trade? In other words, can we go there and say, let's stay a specific time, buy, sell this? Yes, the big runs. I post it every day. It's on Twitter. The Fast Fed Big Runs post every day on Twitter. So yes, I'm gonna answer his question here. Yes, yes, big runs. So the Fast Fed Big Runs every day. We talk about the trades for S&P, oil, Bitcoin, corn, SPY, Apple. Those are specific trades, and I tell you when they're coming. I tell you when the trade's coming. There's a column that says the trade's coming on this day. The easy timer every day, if you log on to the Platinum Trade Board, the easy timer, you'll go there. It will tell you the exact time that the trade happens. These are little trades throughout the day. So on the S&P and on gold, it will tell you the exact time that the trade starts, the exact target, the break-even time, and the exact stop. So yes, all of these are posted. And I would also say, let's see, I'm going to read this. It spells out a specific trade. In other words, can we go there at this stage? And I would also say, yes, I would say closing bell for Fed juice. Each day I have a closing bell where I post the Fed juice. I post if it's on pace. So there's one column where I post that's on pace for a trade every day, every single day. It's on pace for a trade. You can go to the chart. You can see the chart will show its changing signal. There's a new arrow on the chart that shows it. And then on the Platinum Trade Board, it clearly states every day, here's the position, here's the upcoming trade. So if there's an upcoming trade, it will be on that closing bell. Let me see if I can load this up. I don't want to give away too much information here. I had some subscribers barking a little bit about that they felt like we were giving too much away in these webinars. So I'm trying to like balance it out with you guys. But like, yeah, so in the Platinum service, you'll clearly see there's a column that says, there's a change. The trade is changing on this day. There's a date, there's a time. And if you go to the big runs, it tells you very clearly, this is when the trade is coming. There's notes. It tells you there's a trade coming at this time. If you go to the easy timer, it clearly tells you, I mean, that one's as clear as day. It's like I have all the trades for the easy timer for the whole week already laid out for you. It says time in, break even, timeout, target points, stop points. And then if you want to know the easiest trade of all, to answer your question, the easiest trade of all, okay, if you want to know, the easiest trade is going to be the double lunar cycle. The double lunar cycle tells you exactly, when the trades are coming. So you just go, it's at 4 o'clock. That's it. So whatever the date is, it's at 4 o'clock. So all of those are there every single day, spelled out clearly. So yeah, so that's what it is. I don't know. I mean, you need to be checking out the Platinum Trade Board. So it's on the Platinum member site. All right, guys. So I know I've taken up a lot of time today. So let me just go through a few questions and answers. So people ask me questions. How do you get notified of webinars? So on this YouTube channel, click the subscribe bell and you will get notifications. You can also go to Twitter at Wolftrader, FUTU1, and I will let you know when there's going to be a webinar. Email update. This is a free email list. You can go there. If you sign up, become a member. It's at wolftraderfutures.com. S&P closing bell. So each day on the closing bell, I post updates. So each day that you get updates on the Fed juice and all of this, information that we're talking about today. And then on Fridays, I actually post on the bottom the link to the actionable webinar. So here's a question. So with all these indicators, where do I start? I would recommend that you start with the double lunar cycle because it's very simple. So once again, just going back to that double lunar cycle, the double lunar cycles, this is a price history. This is the S&P 500. This is what it's done. This is the Bitcoin double lunar cycle here. This is the 10-year double lunar cycle. And then this is the 10-year Bitcoin and the S&P put together. So, you know, these are very simple. I'm going to see if I can show you an idea of what these look like on the actual website here. So I'm going to go here to an old month to show you what this looks like because people are very sensitive about sharing information. I'm just trying to keep a balance here, like I said, between these weekly videos and subscriber content. So we'll go into November, and I'll show you an example here. So this is what it looks like here. So very specifically, guys, when you go into these double lunar cycles, these are also listed in the actual newsletters. So you want a specific trade at a specific time. This is at the close. So this was copper. So this was dealing with November of copper. But if we go to gold, or we go into any of these other ones here, let's go to the S&P here. S&P has been just really successful. Okay, so this is S&P here. So this was a November, and so this one here. So you can see here. So as these trades come up here, when you see these times and turning points on the graphs, this is for the 4 o'clock at the close. So the very specific trade time for this would be, if this is November the 3rd, this is November the 3rd at 4 o'clock. This is November the 5th at 4 o'clock, November the 8th at 4 o'clock, 22nd at 4 o'clock, 23rd, 26th at 4 o'clock, etc. So we re-optimize this after the 26th. It goes into this buy here, and so the reason this went into a buy until the 10th was because the new one came out in December, which was on the 10th. So that was re-optimized on the 10th. So that's what's going on with that. So that's a very specific, a very easy thing to follow. If you want to do that, fine. If not, that's also fine. But that's the idea there, that all of these are designed to be at the close. And each of these have different closing bells in terms of their times. But the S&P does close at 4 o'clock. I closed that at 4 o'clock. Question, how do you sign up for the 7-day trial? So to sign up for the 7-day trial, what you do is you go to the site and you can just sign up for 7 days. It doesn't charge you. It's not a money back guarantee because you never get charged for the first 7 days. So if you want to try it out for 7 days, and you'll get those double lunar cycles in the newsletter if you go ahead and try that out. So if you have any questions, you can also just reach me and chat with me. Yeah, so we got into the double lunar cycle. Okay, so I think we're going to end the webinar here, guys. I know this was a long webinar. So thank you, everybody, for coming out on a Sunday afternoon. I really appreciate it. And keep in mind that next week we will not have a webinar. So we'll be back in about 2 weeks to continue our talks with high probability plays. Today was just dealing with a very basic regression analysis of the polar R-squared, which is a custom indicator that we have here on our website and on our service, and it's available to all subscribers, especially the S&P. The S&P, I post that every day, so you can go ahead and check that. But I'm probably going to be implementing that into the charts on all of our different systems here too. So just keep that in mind. And yeah, so we talked also today about the portfolio. So if you guys want to check that out, you can go to the website wolftraderfutures.com. And I do have a page there where you can check out those portfolios. Again, if you guys want to sign up, you head on over to pricing at wolftraderfutures.com. Reach me, Shane, at wolftraderfutures.com. And again, you're watching Wolf Trader Futures YouTube video. If you like the video, go ahead and like and subscribe right now on the channel, and I'd appreciate that. Let's build this channel up. Let's get it big. We're going to come with new content every week. And so if you guys have content that you want to see, just let me know. I'll try to incorporate it into the video. But the focus right now is going to be on high probability plays, and we're going to be focusing on that for about the next 4 webinars. Each week is going to be something a little bit different. And so that's kind of a new area that I'm retooling and revamping in the service, because I want to give people plays that are just 1-day plays also. The code breakers is a new trading service that's coming up in the next few weeks. Uh, the Code Breakers is dealing with analyzing the code and the sequence of the market up to a certain day, and then it's going to predict the next day of the market. It probably trades once or twice a month, but that's coming up. It's available for Platinum subscribers. I will let you know when that's available. So it's super exciting that's coming out. Now, for those of you who are subscribers, S&P subscribers, usually I post the S&P video after this webinar, but since we did it this Sunday, I actually made the S&P video this morning, so it's already updated for you. So if you want to hear everything about the S&P and the Fed meeting and all of these turning points, head on over to the S&P newsletter, check that out. It's a really good video. I talked about it. I talked a little bit about today too, but I didn't go into specifics. So they're going to be two very different videos. And in that video, I give very specific dates for all the subscribers. So long day, guys, long video, but thank you for coming on a Sunday. This was a really quite an honor to have this many subs today, to have this many views, to share this information with you. I hope everybody has a great holiday, and stay safe out there. There's the new Omicron variant still out there. Hopefully, it's a more mild. It seems like it is, but it's still out there. So stay safe, everybody, and I hope everybody has a great night. And I will talk